Today, we're talking about how to value a business in real life. Do all businesses use the same method to calculate the valuation? I'm Nolan Baum, and I'm a real life, actual business broker sharing industry secrets so that you can sell your business for top dollar. Let's dive in. First off, business valuations are really hard. 90% of businesses listed are overvalued. Valuations are an art and a science, but more of an art than a science. You're either good or bad at valuing businesses. You need to have a perfect blend of left and right brain. From a bird's eye view, there are three overarching methods of doing valuations for normal, everyday businesses: the market approach, the asset approach, and the income approach, which is basically the discounted cash flow approach. The market approach is used for normal, everyday Main Street business sales. The asset approach is when the physical assets of a business are worth more than the business as an ongoing concern business. The discounted cash flow method isn't used in small Main Street businesses because Main Street businesses aren't predictable enough. There are exceptions to this rule that I can explain in another video. That being said, all three approaches are cross-referenced and triangulated to come up with the final valuation. Since the market approach is the primary method for profitable businesses in real life, let's dive into it. The market approach uses a multiple of either SDE or EBITDA to come up with the valuation. Should you use a multiple of SDE or EBITDA? What's the difference? SDE stands for Seller's Discretionary Earnings, sometimes called Owner's Discretionary Earnings, ODE, or just DE, Discretionary Earnings, or Owner's Benefit, and sometimes cash flow, even though it's not technically cash flow at all. EBITDA is earnings before interest, taxes, depreciation, and amortization. Both SDE and EBITDA are measures of the normal operating income of the business. How to calculate operating income and operating expenses is for another video, but just stay with me. The difference between SDE and EBITDA is adding back one owner's full-time salary. If you have EBITDA, then just add back one owner's full-time salary, and now you have SDE. When do you use SDE versus EBITDA to calculate the valuation? The best answer is it depends on the most likely buyer. Buyers will use a multiple of EBITDA when the buyer is not going to be running the day-to-day operations. They're going to put in place either a general manager or CEO. What kinds of multiples can you expect for your business? In general, if your business is doing $75,000 or less in SDE, then you'll probably get a 1 times multiple because $75,000 is basically just enough for the owner to live on. The risk is really high. For example, if your SDE is $75,000, then your business might be worth $75,000 or less. The bigger the business, the less riskier it is, and the higher the multiple is. But in general, multiples range from 1x to 3.5x for small to medium-sized businesses. There are exceptions. All businesses in all industries can be valued using the same general type of valuation, but different types of buyers will use different methods. Each type of buyer will recast the financials to what they would be if they bought the business. Their expenses might be different than yours. They might have synergies, they might have greater buying power and get better rates and discounts or rebates on suppliers. They might have better systems and processes, etc., etc. And there are so many types of buyers, like private equity groups, family office groups, individual investors, and many other types of buyers. They come in all shapes and sizes. Even private equity groups come in all shapes and sizes. I'll have to make another video about all the different types of buyers there are, but for now, you get the point. I will say that search funds and searchers are basically blacklisted in the industry. There are some exceptions, but searchers are basically the worst. A valuation of a business is either right or wrong. If your asking price is right, you'll sell the business fast and buyers will be fighting over it, which puts you in a great negotiating position. If the asking price is wrong, the business probably won't sell until you lower the asking price. The longer the business sits on the market, the less likely you are to sell it. This is just an introduction to valuation, so if you have questions, just post them in the comments, and I'll see you in the next video in part 2.